to Wendy, just, oh, there we go.
Just throw it
Back up a little bit. So welcome everyone once again. Mortgage interest rates. Where to start with mortgage interest rates? Maybe I could just take a quick, just in the room. I asked Wendy earlier this morning, she thinks, maybe on a scale, she's 5, 6, 7, she has a pretty good understanding of mortgage interest rates, what drives mortgage interest rates, what causes them to go up, what causes them to go down. Not that I want to put anybody on the spot, but this is going to be I'm going to take it from a, nothing standpoint, right? Like right from the start, right from the, what drives mortgage interest rates, that you don't know anything about mortgage interest rates. So to start, the first thing I would say about mortgage interest rates, a lot of people don't get, because they hear, hey, the Fed's going to raise the short-term prime rate, rates are going up, and mortgage interest rates is a market, right? Think of mortgage interest rates kind of like a stock. It's traded every day. A lot of people don't realize that. They think it's the Fed can do something and it goes up or down. Mortgage interest rates are really likened to a stock, right? So it's traded daily. It's traded just like a stock would be traded. So it's a market, right? So mortgage interest rates think of it as a market. It's not like a short-term Fed funds rate that we're going to talk more about as we go along. Mortgage interest rates it's likened to a stock, and it's tied to the bond market, right? And the bond market trades every single day. It trades every day just like a stock trades. So people wonder, well, gosh, I heard mortgage rates are going up, but the Fed's going to raise rates. What mortgage rates react daily to what's going on. And we're sitting in a day, it's really kind of ironic that we're having this today. The Fed funds chairman he might be done now, but as I left my house, he was testifying on Capitol Hill. Okay. Fed Director Paul, what's the guy's name? I'm sorry. Powell. He's testifying today in front of Congress, right? And they're grilling him, right? So he is in a tight spot right now, right? So he's the guy who decides if the Fed funds rate goes up or down, right? And they're grilling him. There's people on Capitol Hill who are saying, well, hey, why haven't we already raised the short-term interest rate, right? I mean, and he's having a little bit of a hard time justifying why maybe that hasn't already happened. Okay. When he does that, or why he would do that, is because of inflation, right? We all know that inflation is a real thing now, right? It's not transitory. It's not short term. The word that was used from August until basically all the way probably up until December, transitory was the word. Transitory meant short term. It's not real. It's going to go away. It's short term. It's not real. It's going to go away. Well, what happened? The word transitory and the thought that the Fed inflation is a short term went away. Inflation is real, right? So inflation is real. So the Fed's going to have to act. But what's happened in mortgage interest rates, back to the whole market thing, it's already reacted. The bond market says, hey, inflation's real, rates are going up. So basically the bonds sold off, right? So when bonds sell, rates go up. Basically, it's an inverse relationship. So the mortgage, because it's a market, right? Because it's traded like a stock, mortgage interest rates have already gone up. They've already reacted to saying, hey, we already kind of know this thing isn't transitory. This thing isn't short term. Inflation is real. So one other thing about mortgage interest rates, we're going to add the whole Russian and Ukraine thing into this because it's part of this, right? It's the economy, it's the market, it's what's going on. So historically, almost always bad news is good news for interest rates. If it's bad news, right, and that's bad news in the economy, which means are we going to go into a recession? Are we going to not have as many jobs? That's good news for interest rates. So bad news is good news, with one exception: inflation, right? The whole work, this is going to be a lot about inflation, because inflation is why rates are going up. So inflation, is the one bad thing that causes rates to go up. Other than that, usually bad news means good news, lower interest rates, right? So that's what the Fed is dealing with right now. The Fed is dealing with, okay, we have an issue that's going on, a world issue that's going on in Ukraine, and what's going to be the result of that? Are we going to have maybe moving to a recession, a job loss? So actually mortgage interest rates have leveled off and gotten a little bit better in the last week due to the conflict that's going on in Russia, right? So up until today, up until the Fed testimony today, and again, how much of this stuff you guys want to watch, if you really want to tie into it, I don't want to say it's a daily thing, but today, basically the Fed said we're only going to go a quarter. That's kind of what's on the table right now, is when he's testifying today, he's saying, you know what, a half was kind of built into the market. Well, now what's going on with Ukraine and Russia and the potential slowdown of the economy and what's going on here, now, well, we don't want to jump, we don't want to put the brakes on the economy too fast, right? We don't want to halt it too fast and put us into a severe recession, right? So that's the dilemma that the Fed's in right now with raising the short-term rate. Is I got inflation on one hand, and I got this world conflict going on over here. And if I move too much, I'm going to plunge us into a bad recession, right? And obviously that's not good either, right? So he's kind of trying to, what's the right number? Should I go a quarter? Should I go a half? How many more am I going to need? That's the dilemma that he's in. And again, people always ask, well, Mark, you know what, you're the expert. What's going to happen? You know what? Ask yourself what's going to happen in the economy. What's going to happen with world things that really affect, you throw in oil prices to that and inflation, who has the answer to these questions? And people, in his shoes, who know a lot about the economy, he's wrestling with these decisions. He doesn't know. Should I go a quarter? Should I go a half? Is a half too much? Is a half put us into recession? There's going to be a quarter, then how many more after that will be based on, numbers. What do unemployment numbers do? What do inflationary numbers? Right now, again, back to inflation. Everything's about inflation. We all feel it, right? It's we're paying more at the pump. We're paying more for food. And so he basically wants, there's too much money chasing, too few of goods. And basically the Fed chairman is saying, well, we need to raise rates to slow that down. Okay. So with that said, any questions on where we're at so far? Long-term rates. So bond market. How about bond market? That makes sense. Daily trading bonds up or down. Questions on the difference between bond market. Maybe I should touch on just a little bit about, the bond market. Why do people buy bonds? Maybe I'll ask that question to the group. Why do people buy bonds? Long-term rates go up. Why do they buy bonds? It's a market, what's going on with the bond market? If people are buying bonds, why are they buying bonds? If you're buying bonds, remember, that causes rates to go down, right? The more you buy bonds, that's causing long-term rates to go down. Again, that's a market, right? It's that market that trades every day. Why are people buying bonds? They're buying bonds because it's a perceived safety, right? And that's what's caused the market, the interest rate market to come down over the last week to week and a half. They're buying bonds because, oh boy, we've got an issue going on in Ukraine and Russia. We might have some tough times ahead economy-wise. So they're buying bonds because it's the old adage, if anybody heard flight to quality, heard what that is? So flight to quality simply means this, and it's a term that's very associated with mortgages and long-term interest rates. Flight to quality means you're buying bonds for the safety of, it's a safer investment. I can go buy a bond, I can get 1 or 2% on some bond. It's a perceived safety of the bond market. So I'm basically trading stocks. I'm gonna cash in my stocks because I don't know where the economy is going, because we've got all this upheaval in Europe. So I don't know. I've been making some money in the stock market, but I'm gonna buy a bond, right? I'm gonna buy at least I'm gonna get 1 or 2% return on my money, right? So I'm gonna buy a bond because it's safe, because we've got all this conflict going on, and the economy is going to maybe suffer because of it. So I'm gonna go buy bonds, and if I buy bonds, it's causing the interest rate to go down. Remember, bonds up, rates down, right? So basically, it's the flight to quality means quality is the perceived safety of the US bond market. It's a safe investment. At least I can get 2%, at least I can get 3%, at least I can get something instead of losing money in the stock market, right? So anytime there's bad news, again, back to the market, back to bad news, back to what's going on in the economy, bad news, Russia, Ukraine, I'm buying bonds because at least I'm gonna get 1 or 2% return on my money versus losing money in the stock market. That makes sense? I mean, and in really simple terms, I mean, that's kind of it, right? I mean, that from a what drives interest rates, that's kind of it. Well, what causes the bonds to go up, bonds go down? Well, back to the inflation. Well, that's the one thing, remember, that inflation is the one bad news that causes rates to go up. Okay, that's the only thing, right? And the reason that is because you have to raise the interest rate to slow down the economy, to put the halt on not enough goods, too much money. Basically, they're saying we'll slow it down. You know, we're going to raise the rate, we're going to slow the economy down, but Powell's dilemma again is I don't want to put us into a recession. I don't want to raise it too much, because if I raise it too much, now I'm going to dive us into a recession, right? Short-term rates, long-term rates. Short-term rates are, that's the only rates that Powell has control over. The market's the market, right? Again, back to the bond market. The bond market will react how it reacts. And that's a market. Again, think of it like a stock. Mortgage rates like a stock. Investors are going to trade that how they feel best, right? What's going on in their own minds. Powell only controls short-term interest rates. Okay, so that's the money that the banks lend, right? That's your HELOC, that's your second mortgage. That's your car loans. You know, if the bank wants to go to the Fed, you know, if you drive down the street or you see a new subway going up, right? And the bank can go to the Fed to borrow money, right? That's the short-term rate. That's the Fed funds rate. That's the only rate that Powell has control over. So when you hear Powell raises the rate a quarter, or the Fed raise the rate a quarter, that's the short-term rate. That's the rate that he, as an individual, the Fed chairman committee, the central bank, that they can control, right? They don't control mortgage rates. Okay, now will mortgage rates affect to all or react to all of this? Sure, right? It's a market, right? Again, back to it's a market. It's going to react and buy bonds based on what's going on in the economy. You know, where do I put my money? You know, where, you know, I want to get 2% return on my money because I don't want to lose money in the stock market. At least I want to get some return on my money. That's mortgage rates. Any questions on that? Does that make sense? I mean, and that really is the, you know, why are mortgage rates high now? Why have mortgage rates reacted already? Why are they where they're at? But we still have the Fed funds rate basically at zero. It's because they haven't done it yet. They haven't, and some are saying, and again, if you watch this stuff kind of like I do, they're grilling them on, you know, you can go home, turn on the news, and you'll hear that Powell was testifying on Capitol Hill. Some of them are grilling him right now. Why hasn't he moved? Why hasn't he put the brakes on it? You know, if he puts the brakes on, if he raises Fed funds, that may have helped inflation, right? Maybe maybe we wouldn't be paying as much at the pump right now. Maybe we would be curbing the inflation. Again, I wouldn't want his job for nothing, because you know what? So all of a sudden they're talking that, and then all of a sudden Ukraine and Russia blows up. And now you have a whole different set of circumstances. Now you might have the economy slowing down on its own, right? So if he raises too much, and then you have the conflict at the same time, it plunges us into a recession potentially, right?
So do you think with all this happening, the rates are going to go a little bit down, or?
Well, and that's a great question. They have been, after the jump up. So again, this was, when I said, hey, let's teach this class, or let's talk about this. I mean, because obviously people ask, right, where are rates going? That's what they want to know. Rates, where are they going? That's the same question I get. If you send me a customer and it's like, hey, we just signed a purchase agreement, or maybe they're a pre-approval sitting in the drawer, and I'm looking to buy a house, and I'm worried about rates, and so you want to have this kind of conversation, right? And everybody looks to you and they ask the same question. Hey, Mark, what are rates going to do? So the answer is, you try to formulate basically a conversation around some of the things that I just said, right? Maybe in a shorter, understandable conversation, right? So you have somebody like Powell, so the answer is, he's sitting there, probably doesn't know for sure, right? He's trying to help decide where they go, but he doesn't know for sure, right? Because again, when you deal with a market, it's a market, right? So it's did he know that there was going to be a Ukraine, Russian world event? No, I mean, so there's things that happen. Do you kind of have an expectation? I mean, if so, the answer is a lot of it's going to depend upon what's going on in Russia and Ukraine. It's a big deal. I mean, it's a big deal. I mean, it's ironic we're having this right now, because I would say this, and sometimes when people, have asked me that here over the last week, it's like, how, go ahead, question. No.
Because I remember back in December, you did mention something about the interest were going to go up. I remember.
Exactly. And you know what, that's why this is such a good thing, because to really know and kind of follow this stuff, you can just see how one world event could kind of change things right on the dime, right? So I think it's as agents, certainly in my job, I mean, I wake up to this stuff every day. I turn on CNBC for the last 30 years. I turn on CNBC and I listen to it, right? Not that I'm trying to say, well, hey, I'm going to buy some stock, or I'm going to buy some bond. I just want to know what's going on, right? And every day something could change. So right now, Russia, Ukraine, rates have come down because of that. Again, because usually bad news spells lower interest rates. It spells a potential of a recession. And anytime there's a recession and a big slowdown, people lose jobs and they're not buying money. It slows the economy down, and people are gonna, and rates are gonna go down, right? Why are they gonna go down? Because people are probably gonna get out of stocks, and they're gonna, again, flight to quality, right? Remember that word, flight to quality. You hear that word, flight to quality. Flight to quality means at least I can get 1 or 2% in the bond market, and I'm probably gonna lose money in the stock market. So I'm gonna buy bonds. And so if I buy bonds, again, inverse relationship, buy bonds, rates go down. So what happened was, I think when I spoke that day, I think they were maybe talking about Russia. It was like he was amassing troops on the border, right? But I don't know if anybody, I mean, I watched news on this stuff, and it's heartbreaking, because most of the people didn't expect it to happen, right? They didn't think it was going to happen. Right. I mean, people are like, we didn't think it's going to happen. They're in their basements, and, they're like, I didn't think it was going to happen. We didn't think it was going to happen. And so it's a world event like that caused all of a sudden people to get out of stocks and the flight to quality. I'm going to buy something, at least I can get 1 or 2% in the bond market. Right. All the while, the Fed, back to Powell in the short-term rates, have done nothing yet, right? And again, I'm not saying good or bad whether he has or hasn't. I mean, there's people that will say, well, you should have raised the short-term rate and slowed the economy 2 months ago. There's some that are saying, well, if you would have done that, it would have slowed the economy down and we'd be moving towards it. So again, I wouldn't want his job for nothing to try to figure this stuff out. But to answer your question, a lot of it's going to depend on what happens in the Ukraine going forward. I mean, God help it doesn't move to a bigger thing. You know, and I don't want this to be a doom and gloom, but it is real world stuff in that if it turns into a bigger thing, if it escalates and maybe starts to move to even neighboring countries, we probably will see lower rates. We probably will be looking at moving towards a recession, and recession will mean lower interest rates. If it turns into a, and again, if it turns into a, we bit off more than we could chew, we made a mistake, we're going to back off and let's just, reset and come to a peaceful solution. Now the talk is all back to inflation and not the negative world event. Rates probably go up, right? Now it's all about inflation, and there still is inflation. How bad it is, again, we will all, I don't want to say discuss, or that's going to be them to figure out, right? And that's when they start moving rates and the short-term rates. And while they're doing that, the bond market will react earlier because, again, it's a market, right? So the bond market's already reacted saying, hey, excuse me, rates are going up. They're already ahead of Powell because inflation is real, right? They've already traded it because it's a market, right? They've already said, hey, excuse me, that interest rates are going up, inflation is real. And that was the only issue 2 weeks ago on the table was inflation, right? That's why rates went up. That's why mortgage rates shot way up. And that's why we are where we are. Now, like I said, the Ukraine-Russian thing brought a whole different dynamic to it that stabilized rates and caused them to come down, right? But that doesn't mean that inflation is still isn't real and still out there. So now you got two things you're dealing with, right? So great question. So I don't know if I asked it. I mean, I hate to answer a question with another question, but it's kind of what you believe is going to happen going forward. I mean, I can tell you what my hope is. My hope is that there's a resolution, there's a resolution in Eastern Europe, and we just get back here to dealing with inflation. We just deal with it. It's like, okay, why did inflation happen? Whatever. Obviously, we pumped a lot of money into the economy, and everybody had money, and maybe too much. Maybe I don't know. I don't even want to get into whether or not how we got where we got. But we got to where we were just dealing with inflation a couple of weeks ago, and if we get back to just dealing with that, then it's just it's just Powell dealing with raising the rates and slowing down the economy. And if I mean, there's a lot of things going on there too, right? I mean, it's
We're talking in
does that answer your question? And I think that's kind of what this was meant to be, was because your people are going to ask the same question, right?
Yeah.
That's what they're going to ask. I heard rates are going up. What do you think? What are they going to do? And I think that I've always said to people, and you've all probably heard it too. If you're really doing your job, in my opinion, you're going to give them a good knowledgeable answer as to what drives rates, because right now, the Fed chairman Powell, who's testifying, I don't think he 100% knows. I mean, I think he has a hope, right? But I mean, anybody that stands up and says, well, this rates are going to do X. Well, I mean, this person's he's got a pretty good crystal ball if he knows exactly what's going to happen in Eastern Europe, and he knows exactly, what a 0.25% Fed rate hike will do versus the 50%. And if they're going to raise 5 times this year, a 1/4 point each time, and what each of those increases is going to have as a result in what it's going to do to the economy. Is it going to have the result that he wants it to have, to where we get a good balance, right? If they all know all that, I mean, I'd love to talk to this person, you know, and, you know, I mean, I think you can have educated guesses, but like I said, I stood here 2 weeks ago and everybody in the world said rates are going up because they were going up, right? Fed's going to raise a half. I mean, back that time, the Fed was going to move the short-term rate a half for sure, whatever. And then, you know, like I said, then the Ukraine, you know, situation arose, and that caused bonds to react, you know, a different way. So, yeah, so I mean, Ukraine resolved, rates go up, we're back to inflation. You know, it escalates in Eastern Europe, and rates are going to drop. You know, so I don't, you know how you answer that question. I think you tell people, you know, this is what affects rates. I mean, I don't think, I mean, when people come and talk to me, well, should I lock or shouldn't I? I mean, I think we're in such a crazy rate environment right now. I mean, as I left, and I was going to get to this here shortly, but it's funny, rates are going up big time today, right? So after all I said, down, they've been going down, 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 you know, and then all of a sudden, boom, out of nowhere, I tell you, you know, rates are going up today, right? Why? Well, all of a sudden, inflation seems to be lesser of an issue. You know, I mean, it seems to be like, okay, Fed's talking, he's going to go a quarter, and somehow, some way, the market, again, the bond market. Remember, it's, and that's if you kind of come off with one thing here, it's long-term interest rates is a market. So again, unfortunately, I didn't get to hear exactly what he said today, but he obviously said something that caused, because I'll tell you right now, I subscribe to a service, and the service says that the bonds are down 27-30 seconds. That's a sizable move. You know, that's a fairly negative move on interest rates. And if you looked up and Googled on your phones right now with the 10-year, even though the 10-year bond isn't exactly the Ginnie Mae bond and the Fannie Mae bond, it's a pretty decent indicator of that will follow the Ginnie and the Fannie Mae bond. You will see that I think it was 1.8 when I left the house this morning, the 10-year Treasury bond, which is up from about 1.7. I believe it was trading at yesterday. So he said something today that caused the market to say, uh-oh, you know, from an interest rate standpoint, you know, or, and now I'll bet, again, if I look further on my phone, and there you go, the stock market's up 668 points, right? So what happened, right? So if we just talk about that, what happened? Basically, money came out of bonds, right? They sold bonds, right? They sell bonds, rates up, right? Bonds down, rates up. So they're selling their bonds, and they're buying stocks based on something he said. I'll find that out later. But again, if you truly want to kind of get this from a day-to-day basis, it's almost like things can change on a dime. You know, so I actually, that's why I feel a little unprepared, because I had a purchase agreement come in this morning, and that's why this stuff is so important, right? I mean, I needed to get that loan locked. I needed to get it locked because rates are going up. I mean, I deal in pricing every day, right? And you know, all I can do, I can't necessarily tell somebody what rates are going to be in 2 weeks with certainty, but I know with certainty rates are going up today. I mean, those are the things I think you can you know, look to and know for certain that 10 years up, ugh, you know, call your lender, get it. Even if there's anything that you're sitting on, or if you just got a purchase agreement in, get to your lender and get that thing locked in, right? I mean, so he didn't start testifying until after the market opened. It was relatively flat. Yesterday was a good day. Everything was good, right? We've been saying everything's good. Rates are getting better. Rates are getting better because of the whole, you know, Ukraine thing. And then all of a sudden, boom, out of nowhere today, Powell testifies, and whatever he said, the stock market loved it, bond market didn't, and rates are going up today. So I'm assuming it had to do something, you know, with inflation. Maybe you know, Ukraine is a bigger deal, inflation is a bigger deal, right? Because inflation is what's causing rates to go up. So maybe I'm guessing he said something. I'm guessing he said something about inflation's bad. You know, I'm assuming it had something to do with inflation. Is that somebody had a question or was that? Any idea?
She's not muted. I think she accidentally,
Gotcha.
there's a, what was that, yours, mouse? There's somebody else, I think, maybe somebody else.
So, yeah, so that's actually, yeah, I don't think I've seen the Dow.
Martha.
You haven't seen the.
I haven't seen the Dow up 660. Well, maybe it was, I don't know. I can't, the days all start to mush together, but up 600 points is a pretty big move. You know, I don't, you know, that's been a pretty big move. Everything's been pretty negative lately, so.
It's been really up and down though. Like, I think it was very shortly after the Ukraine conflict started, it dove down 1,000 points and then, but then went back up. This
And
is
then
all
went
in the
back,
same day, but
Right.
it's been up and down and it's slowly been creeping it back up.
Right. And again, I find this stuff interesting. I mean, again, it's what I do, so I'm watching it. You know, it's every day could be another, you know, a different turn. I mean, right now is a very interesting time because that's a big fluctuation down 23-30 seconds. Actually, the Fannie Mae right now is down 27. That's a sizable move. I mean, we don't see those kind of moves that often. That just shows you how jittery the market is right now. You know, boom this way, boom this way. You know, I mean, it's investors don't know, right? And so I mean, to go back to your question, you know what I think. I mean, there's investors right now chasing the bond market, chasing. They don't know, right? They're bouncing back and forth because they don't know. You know, if anybody knew for sure, these again, I'm gonna keep harping on these are markets. These are markets, right? You could park your funds in a certain place. If you knew something was going to do something, you can start getting into shorting something, and you can make a lot of money if you knew with 100% certainty which way something was going to go. But there's people who do this stuff every day, and they're tied to their screens, and they don't know which way things are going to go. They're looking at these numbers, you know, minute by minute, day by day. So I think the biggest thing, you know, for all of us is, as we're talking to our customers, is just being in tune to what's going on and be able to just tell them what's going to affect it. You know, if they ask me what's going on, I kind of say the same thing I say to you guys. I give them the, you know, if you think this is going to happen, this is what's going to cause this. But is anybody not going to lock right now? I mean, if you had somebody come in, you know, I mean, you know, you guys are you know, real estate experts. What would you say? What would you say to your customer? Or would you say, talk to Mark?
Yeah.
Talk to Mark. Of course you would.
Bring it to the bus. No,
Yeah.
just kidding.
And that's okay, because I would, at the end of the day, I'm never going to tell somebody not to lock a rate in this kind of a volatile market. You know, I mean, if you want to bet on it, you know, I mean, again, a lot of times, that's why you have to have that knowledge to explain to them what causes it to go up, what causes it to go down. And if they say, hey, you know what, I think this is what's going to happen, then they kind of made their own decision, right? You know, because there's no way I'm ever going to tell somebody not to lock, and there's no way I'm ever going to say, tell somebody you got to lock, right? Because what happens as soon as I tell somebody they have to lock, or they should lock, and all of a sudden then tomorrow the rates are an eighth lower, or a week from now they come to me and say, well, dude, you told me to lock. You know, I mean,
So once you lock, you can go back.
we all there's a joke, Wendy. It's, you know, if kind of like, don't call us, don't, you know, we'll make a deal with you if they go up, we won't call you to renegotiate. You know, if they go down, you know, you can't call us. You know, I mean, it's, yeah, because you know, and then, you know, that's getting into a whole nother conversation when you lock loans and you lock a loan and it's committed to a, you know, to pools and you know, mortgage-backed securities and, you know, they're locking, you know, and expected to deliver that one. They're their best effort deliveries, so they can be canceled. But, you know, I mean, you know, 9 times out of 10, I'm never going to say never, you know, when it comes to something that's locked, if rates come down dramatically, that maybe something can't be done. But, you know, the easy, simple answer is yes. When it's locked, you know, up or down. What else? What else can I help you? I mean, that's the basic gist of it. I mean, if you said, well, okay, that kind of helps me to understand what drives rates and market economies and or the economy drives interest rates, just unemployment numbers, right? I mean, you know, well, what else can cause rates to go up or down? I mean, obviously, we're only talking about a couple of things. We're talking about inflation. We're talking about, you know, the Eastern European conflict. I mean, what else? I mean, obviously, it's unemployment numbers, right? I mean, there's numbers that causes rates to go up or down, but not as on a drastic basis as we've seen, right? I mean, you get unemployment numbers, right? And so, what causes, you know, unemployment is super high. You know, if everybody's working and you know, there's too much money in the economy, that can, you know, that can sometimes be bad news for mortgage rates, right? More people working, you know, less things out there, and back to the whole inflation thing, right? Again, other than inflation, bad news is good news for interest rates, right? If there's more people unemployed and job numbers are less, that usually tends to, you know, if an unemployment number comes out and that unemployment number is worse than expected, you know, that usually means lower rates, because less people working means a potential for a recession, which means, you know, the old flight to quality thing. So the easiest thing, I mean, again, I hate to say that mortgage rates are the benefactory of bad news, but it's true. Bad news usually means good news for interest rates, with exception of one thing, right? And that's, again, inflation. Yep. And like I said, to stay in tune to it, it's a very, very up and down market right now with what's going on. We had times of, you know, again, you get into fiscal policy and what's caused rates to be so low for so long. You know, there's certainly a deeper dive that we can always do. You know, I mean, how many of you raise your hand if I said, boy, the Fed, the government's kept rates artificially low for a long time? Would you say, yeah, I kind of knew about that, or knew why, or yes, no? We've been buying bonds, right? That's why I kind of started with the bonds. If you understand the whole bond thing, you know, you can understand when you hear, you know, raise your hand if you've heard of Q1, Q2, Q3. No. Q1, Q2, Q3. I mean, it's you know, this kind of goes back to you know, the government's kept rates low, right? I mean, the government, I mean, they pump money into what? You know, what causes, this is the test, what causes rates to stay low, right? Buying bonds. Okay, well, government said, you know what, we're going to take a whole bunch of money and we're going to buy bonds, right? I mean, we can buy money, right? We can buy debt. You know, the government's been purchasing that. That's been part of what's been going on here the last number of years is, you know, Q1, Q2, Q3, you know, and I don't like to always look in the rearview mirror, because this stuff is all going away, right? This is the stuff that we're leaving behind, is the Fed buying debt, buying bonds, and keeping the interest rates, I don't know what to say, they're artificially low. You know, some would say, well, just let the market dictate, let people buy bonds if they want that safety, and you know, but you know, we've all kind of liked lower rates, right? So that's part of this as well. The government's getting out of purchase of bonds. They're tapering. You know, the word tapering. You know, some of you probably heard of tapering. You know, they're tapering. They're leaving the bond buying business. You know, so that's going to have an effect on rates too. You know, if they don't buy bonds, right? If they don't pump billions of dollars, I'm talking lots and lots of money into buying bonds, that's, you know, just the fact that they're not gonna buy them is gonna cause rates to go up. And also has caused rate, because they've tapered it. So tapering just simply has meant that they've been lessening how much money they're pumping into buying bonds. So, I don't know, let me ask you, what do you think rates are gonna do?
They have to predict.
They're gonna go up?
What term are we?
I hope so. You know what? Because you know what, if that happens, the Ukraine and the Eastern European thing is gonna be settled. It's gonna be a non-event. There's gonna be a good ending of that, and let's just deal with it. You know, let's deal with what we probably, I don't want to say we did on our own, but you know, we got ourselves into inflation or however it happened. I'd rather deal with that. I hope you're right. You know, because I hope the Ukraine thing is settled. And then we just have to deal with, you know, higher rates to curb, to slow down the economy. And, you know, maybe that causes house prices to stabilize some, and, you know, higher mortgage rates don't kill our business. Maybe higher mortgage rates is good for our business if it slows and houses aren't worth 20% more, you know, 6 months later.
You don't think there's gonna be a crash in the market, right? Say it.
No, I don't. I mean, no, I don't. I mean, do I hope for, I mean, you asked me, you guys are on the street talking to as many, if not more people than I mean, you see house values, you see the number of people, 20 people wanting a house. I mean, I don't know how do we get to a point of, you know, what we would consider a normal market again. I mean, all I know is that I don't want to call it a crash. I hope for a, I mean, would you agree? I hate to always answer questions with questions, but if house values maybe went down 5%, would that be maybe good?
Yes,
I would agree.
it would help even out the market. You know, more the buyers equals sellers and back and forth. You know, the Ukraine situation, I don't think it's going to be resolved quickly, even if the conflict is resolved. The sanctions against Russia, that's huge, and I don't think that's going to go away. And that affects the oil, that affects a lot of things.
Now we got you thinking about exactly, this is the stuff I think about every day, right?
Yeah.
Because I think about it. I would turn on the news like everybody else and I watch it, you know, because I certainly have an interest in it just from a people standpoint of how they're doing, but I also
But
have
there's
a,
also the analytical standpoint. And then I think,
Exactly.
going full circle, we're all back to where we started from. We don't know for sure.
and that kind of brings it to the point of, I don't know how anybody can answer the question of where rates are going, right? Because how can you predict this stuff? I mean, you know what, I'm listening to people who know a whole lot more than me, people that are having these diplomatic talks but you know what, I knew something. I mean, you know what, because I mean, Biden did say they were going to invade. So somehow, some way they knew, I mean, they knew some stuff was going to happen, you know, I mean.
They know a lot more than we realize.
Right.
You know, the intelligence and such, it's so, I think, deep into Russia and the rest of the world that we have really no idea how much is known. I mean, it's a lot more.
Right. And you know what, I think the biggest thing is this, is like, you know what, all these things affect rates. They affect rates. They do. They affect rates, you know, what happens, you know, day in, day out, right? I mean, you know, and that's, I think the biggest thing that I was hoping to get from this was these things affect us in the interest rates and what people pay every day. And if you really want to have a good conversation, then you got to be probably an NBC nerd like I am, and just, you know, you turn it on and you just listen to what's going on and what happened today to have the effect on rates. And you know, yeah, I remember Mark talking about, yeah, bonds, buying bonds. Things happen almost daily that affects the market. It's a market. It affects what people are buying in bonds. You know, are they getting rid of stocks, buying bonds? And it has that effect. And to your point, if you're right, and I sure hope you're wrong, that I mean, again, you know, from a, it probably means lower rates. I don't know what that means from a world. I mean, again, I mean, what's better, right? I mean, again, you get into, you know, do people start losing jobs because it plunges us into a recession, and all of a sudden we go from, boy, everybody having a bunch of money and money's chasing money and we're dealing with inflation, to companies aren't making money and they're laying people off. That's what the market is wrestling with, right? And if you're right, because I'd rather deal with inflation than deal with people having issues in Eastern Europe, and on top of that, then that potentially leads to a and then that, you know, leads to your question is, maybe there is a bubble, you know, maybe that creates a bubble. That, you know, who knows? Again, all I know is I'm going to stay in tune to what's going on. I don't know. I'm never going to be I'm going to tell you what's going to happen, but I'm going to know if this happens. If this happens, I know what to expect. You know, I can have an educated knowledge of what's going to happen. If something does happen, if this happens, this is probably what's going to happen. If this happens, this is probably what's going to happen. So I can hope and root. And if there is anything small that to push something, I mean, again, you know, again, you get it. We haven't even got into the whole oil thing, right? I mean, I don't even want to get into the, you know, oil thing and how oil affects and what's going on, you know, with oil and I mean, but it has an effect, you know. But the point being is, as you hopefully take a deeper dive into this stuff, it has an effect. You know, oil prices have an effect. When I left the house today, I think it was $110 a barrel at one point earlier this morning, and I think it was 108 when I left. $108 a barrel oil. I mean, we haven't seen $108 a barrel oil in, I don't get the numbers, it's been a while, you know, I mean, so does that have an effect? Yeah, absolutely it does. I mean, you know, I mean, it has an effect on the economy. And certainly, again, I mean, I don't turn this all into mortgage interest rates. I guess that's why we're here today, but it does have an effect on mortgage interest rates. You know, I mean, if they're talking $150, you know, and maybe that's what I'm trying to, if any, you know, things come from this. I mean, I don't want to turn it into a doom and gloom conversation, but I mean, they were predicting $150 to $200 barrel oil this morning. That's possibly the other part of what's happened with bonds as well. I mean, I don't know, what is $150 a barrel? I mean, we're at 108 right now. You know, what does $150 barrel oil mean? What is, you know, the 200? I mean, you know, there was a person, you know, expert on there that, you know, they were from the industry that said that's where we're going.
Everyone buys electric.
I think that would be the wonderful, well, yeah.
What did you say? Everybody buys electric. Then it puts a strain on the grid, so.
That would be a
I don't know
long-term
that we have the
solution,
infrastructure for.
but not
all of it.
immediate.
I think that's the goal, right? And we would all love to, you know, flick on the generator or the, you know, and have solar panels and wind. I mean, I think that's obviously what everybody's goal would be, right? Is to have, you know, renewables and electric and green, and I think that's kind of the, you know, the push and pull going on a little bit right now is, you know, what's the right way to go, you know, and how fast can we get there? I mean, I don't think anybody denies that they would love for that to happen, you know.
Just an investment.
It's an investment. It has to have, right. And you know what? And you know, there's a lot of people that says, you know what, that's gonna make us get there. You know, and some will be okay.
Geothermal.
And some will be okay with 150, let it go to $300 a barrel because it'll get us there faster. We'll have to go, I'm not gonna turn it into that conversation, but there'll be some pain along the way, but like you said, it'll make us get there. We're only 7 minutes away. I don't know. Does it, any other questions you guys can think of? I mean, we can dive into this. I mean, again, you get into oil costs and you get into, but what I would say is, hopefully, you got across the whole bond market thing and that it's a market, and it's a daily thing that affects mortgage rates.
I do have a question.
Yep.
I've heard you say twice, not just today, the 10-year bond that you watched.
Yep.
To see,
Yep.
what does that look like if I were to go look?
Just Google 10-year treasury, and you'll probably get nine different things. I mean, it's a 10-year T-bill, 10-year treasury, and that's the nearest thing that you can get if you kind of wanted to watch it from a day-to-day basis. If you turn on CNBC in the morning, almost every morning, they're going to tell you where it's going, because it's a rate, right? It's a big thing in the economy. So it'll be, red, it'll be like a down, lower rates. Green will be up. Again, when I left, I think it was 1.8 something. It's been as high as 2. I don't think it got to 2.1. Went down to 1.7 yesterday. It closed, I believe, at 1.7 something. When I left, it was 1.8. So
And the up and down, and that is how interest rates are going?
exactly. Yep. It's almost like and I kind of use it as a rule of thumb. It's not 100% true, but back before I started buying all the actual services, that if you add 2% to that, it gets you kind of close to where the mortgage rate is. It's kind of a good gauge to say if I add 2 to the 10-year, that's going to get me pretty close to what an actual 30-year mortgage might be. So if I added 2 to the current 10-year currently at 1.8, 3.8, it's pretty close to where our mortgage rates are right now. Again, that's going to be for your good credit type person. If you've got somebody with lower scores, it's going to be different. But so yeah, the 1-year T-bill. And like I said, I don't know. So I find it, again, maybe I'm an interest rate nerd, but I find it interesting. Some people, some of this stuff, hopefully, because you turn that stuff on and they start talking, and it gets to be like, what? We're throwing out the baby with the bathwater and flight to quality and all this stuff. And sometimes you just have to say, okay, call me and say, Mark, this guy was talking about whatever. What does this mean? Because honestly, even, I could think of, transitory. What do they got to come up with transitory for? Why can't they just say we think it's short term, right? I think sometimes, these are very smart people and they're educated people. But I don't get, they have to talk in terms that, why can't they just say, we think inflation is short term? So the average person can just understand it instead of it's transitory. I had to finally Google it. What are they talking about? And I've been looking at this stuff for years. Like, oh, it means short term. They think it's short term. Okay, why can't they just say that?
It's like bad words for kids. You got to keep coming up with new ones.
Yeah. So, but I think the more you watch it and the more you kind of see and you kind of like, okay, and there's always predictions on this stuff too. There's always like, they think the number is going to come here. And so if they think the number is going to come here, usually the bond market, the reaction is relatively mild, right? Because again, because it's a market, they've already traded it at a certain point. If they think the number is going to be here, well, if the number comes out about where we expect it, it's kind of a non-event. They don't really react to it, right? If it comes out like, ooh, this big, and that's why I kind of like watching it. It's like all of a sudden, boy, unemployment numbers or inflationary, like the producer price indexes, the PPI and the CPI, the consumer price indexes, the inflationary gauges or monitors, how bad is inflation? They run numbers on this stuff, right? And all of a sudden PPI comes out, there's an expectation. We think the PPI is going to be here. We think inflation is about here, right? There's a we think it's going to be here number, right? And that's where the bond market has traded it every day up to that point. Now, all of a sudden, it's the big shocker. It's the, oh my God, it came in at this. Watch that bond market, watch that bond market sell off, and rates go up because inflation is a lot higher than they thought, right? That's kind of why I get, kind of a kick out of watching it, because it's like, okay, non-event, everything's good, nothing's gonna, not, and most of the time that's where it's at. Lately now, you'd have a lot of fun watching because it's like then all of a sudden Fed, Powell testifies today, and whatever he said something, my guess is he said something really bad about inflation today, that it's pretty bad, which caused bonds to sell off. But that, again, you watch this stuff every day. It's every day. There almost every day a number comes out that the stock market and the bond market is reacting to, watch it. I mean, and again, and then I think what it can do is you have this kind of conversation with your client, like, oh, she really knows what she's talking about. I mean, she really kind of understands, and you don't have to tell them. You're not a prognosticator that, you're all knowing. You come across as just a knowledgeable person who knows what's going to cause them to go up and what's going to cause them to go down. And, most people, sometimes people they're in business. These people are working. They know if their businesses are doing really well and they're hiring people, and the supply chain, stinks, and we can't get product. We can't get, goods to build whatever it is we're building. They know if they're hiring people, they know if they're firing people, and they oftentimes they answer the question themselves, with, a lot of people that, they sit and they'll tell you and then it's like, well, if that's what you think, then this is what will happen. If you think, X, then this is, what will happen. And sometimes people know more than I think sometimes even think they know. I mean, they've been around, they've been in business. They just don't know this whole bond market thing and what causes rates to go up or down. But, if you tell them that, they're like, oh, okay, well, then this, then this is what will happen. I think, this is going to happen, with long-term rates. I mean, again, I'm in the camp that, personally, I wish Paul would have raised. I just wish he would have raised. I just think that we're a little behind. Okay, we can wait a month or two, maybe, inflation is short term. Maybe we could wait and see, but, we're into March now. And I think most people would say they felt the kind of the pinch, and inflation is real. And, raising a quarter would have, probably helped us a little bit, and, I know they were grilling them pretty hard on Capitol Hill for saying, and you can get into as much of a deeper dive as you want to on some of this, because the big black rocks of the world and the people that sometimes have access to some of this free money. I don't want to turn this into a dark conspiracy theorist, but the Fed isn't like the bond market. We're a market. The Fed is a group of Fed governors who decide whether it should go up or down, and if I could wave a let's fix it wand, I don't know if I'd have just 4 or 5 Fed governors deciding, that can have outside influences deciding whether or not we should raise the Fed funds rate. But anyway, that gets into a whole other conversation. So 132, so I can answer any other questions, or talk to your lenders too. If you want to know day to day what's going on, or if you ever just say, Mark, I didn't get a chance, what's going on? Like I said, I don't know if I've got an update, but I'll see if I've gotten any update. Yeah, no change. But most lenders have access to what's going on a day-to-day basis. If you got somebody that needs to lock in, most people subscribe to some kind of service that tells you what's going on day to day. But anytime you want to know, hey, what's the trend, what's been going on the last couple of days, talk to your lenders, or reach out to me anytime. I follow it, even if I haven't gotten my hour dose of CNBC, I always still have it, on my phone, beeping me as to what's going on right now. And then lenders can tell you right now what's going on. We just don't know what's going to happen. I mean, if you said to me tomorrow, hey, Mark, what are they going to do tomorrow? That'd be a tougher one, right? I mean, today was a bad day. Sometimes the market overreacts, sometimes it goes a little bit too far, so, I mean, if I were going to guess, I might, unless there's more bad news, or more bad news inflationary wise, but I guess just, yeah, reach out if you have any questions mortgage wise that says, hey, what's going on? I haven't had a chance to see it. I haven't had a chance to kind of pay attention, or I didn't quite get what you said about, or you saw something on whether it was CNBC or whatever, and you were not quite sure why the market reacted a certain way, talk to your lenders, or, feel free to reach out to me anytime.
Do you feel like CNBC was the best place to go?
I
pay
like
your-
it. Yeah,
that's
I
what you
like it.
prefer?
Yeah,
Okay.
I like it.
Okay.
I mean, I'm not saying there's not other good ones out there. I don't know, but I mean, I just think they do a good job. They just do a good job. You know what? And they're going to banter. I mean, I don't ever want to politicize anything, but they got their people on the right. They got their people on, and I don't even want to get in, whatever. It's like, I just want to know what's affecting the market. And so I think they do a good job of telling me what's going on in the market. When I say the market, that's not only the stock market, more importantly, the bond market. So the bond market, because it's a market again, it does. And, Rick Santelli, who's at the Chicago, I mean, he's a fiery dude, and he's the bond market. You'll get to know him, and they all have their own opinions on all this stuff, and that's fine. I'll, listen to their opinions, but at the end of the day, these guys don't know what's happening either. They just tell you what they're reacting to what just happened.
So you said if you look at the 10-year bond and you can add like.
Yeah,
2%?
yeah. I mean, I think that's a decent, enough just to kind of get you in the ballpark, but it does a good job of, like, on a daily basis, and how much is it moving, based on, what came out today, to make that 10-year, go up or down.
Thank you.
Yeah, you're welcome. Good.
Good.
Yeah, thank you.
Yeah, you're welcome.
Thank you.
You are welcome. I'm gonna stop.
Thank you for that.
Are you sure you want to